Balance of payments. Huge point in here about the balance of payments and how we calculate it, but it's going to be based on a relationship that you've seen twice before. So it's not a big area of the syllabus anymore. It used to be a lot bigger than it is right now, but you still need to know these basics. It's made up of the current, capital, and financial account. It is essentially just a dual effect accounting system. So if you have already, or when you look at the financial reporting material, get familiar with the dual entry effect. The idea is this balance of payment account should eventually balance back to zero. So your current capital financial should offset. Exam questions, every chance you get given a transaction and asked whether it belongs in the current, the capital, or the financial. And the rules are as follows. Current account, merchandise and services purchases, so the flow of goods, flow of services, foreign dividends and interest, unilateral transfers. So, to get a kind of woolly, not perfect, but maybe helpful analogy, think of the income statement in financial reporting, anything flowing through. Capital account, bit more balance sheety. So that's the sale and purchase of physical assets, resources, intangible assets, writing off debt, and any death duties and taxes. So kind of split the current and the capital to a little bit of kind of income statement versus balance sheet. Finally, your financial account, domestic-owned financial assets abroad, foreign-owned domestic financial assets. So that would be your debt that you own from an overseas country or somebody else owning yours. That's the idea. Now, once you've got that set up, to be honest, there's not too much else to do in describing it. My advice, do economics questions little and often, and you'll keep picking up questions that ask you, is this flow current, capital, or financial? And if you keep seeing as many of those as you possibly can, you'll be prepped for the exam. What's more interesting is how it moves. So this is the huge point I mentioned moments earlier. You've seen this relationship before. We're now expressing it as x minus m is s minus I plus t minus g. But that is the fundamental relationship from expenditure equals income. C plus s plus t equals c plus I plus g plus x minus m. We're just rearranging. We've now expressed it like this because we are isolating x minus m. X minus m, exports, imports, flow of goods and services. That's your balance of trade. So we can see the factors that influence our balance of trade. Let's just track through this first sentence. It says an increase in private savings. Well, our balance of trade is on the left-hand side. So if savings go up, holding all else equal, X minus M goes up, exports minus imports, if that's going up, that's improving our balance of trade. So an increase in savings improves the balance of trade. Or government savings, an increase in government savings if this term is going up, T minus G. That's taxes minus government spending. So yeah, that's government savings if it's written as T minus G, and that's going up. That improves or increases government savings. And the opposites are also true. The examiner can ask you for the impact on that balance of trade from any of those right-hand side terms. And the most common problem with this question is people just don't know how to attack it. I didn't know what they were asking me. Whenever you get a balance of payments influence question, a balance of trade moving, if they mention tax or government spending or saving or investment, go back to your fundamental relationship. Now, final point to mention on this slide, trade deficit due to a decrease in private or government savings. So we have a trade deficit, so this is turning negative. Why is that? Well, it could be due to a decrease in private or government savings. Well, that's bad news for the government because they're heading towards a budget deficit. Bad news for savings. Well, people aren't saving, there's less investment. That's less desirable than a trade deficit due to high domestic investment. Look at this, that's minus I. So the larger your domestic investment, as this rises, just clear it out, if this rises, this falls. So you could end up with a balance of trade worsening due to high domestic investment. That's seen as less of a problem. We prefer that than government savings decreasing or private savings decreasing.